Today I have two interesting stories for you. In the first one, we'll talk about digital gold and what does SEBI have to say about it. And in the next one, we'll talk about an interesting concept of gasification of coal and where does India stand today with respect to that. Hello and welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and bring you the biggest news in the financial markets in a way that's one level deeper as compared to other news channels. I'm your host, Kashish Kapoor. Today's 12th of November, Wednesday. Through the last decade, there's been a wave of new financial products. One-tap SIPs, roundup investing, and rewards for paying rent by credit card. One part of this wave was digital gold. It came with a nice, shiny pitch, much like the gold itself. Why keep your savings in a bank when you can buy pure 24-karat gold on an app in under a minute? Just tap the 100 rupee button and that amount of gold will sit in a vault in your name. In a country that loves gold, this was very, very attractive. Look at this year alone. According to ET Wealth, UPI transactions in digital gold ballooned from 760 crore in January to nearly 1180 crore by August 2025. But as they say, not all that glitters is gold. These deals might gleam on the surface, but their insides are murky. See, at its heart, digital gold is not a regulated product. There's nobody policing these apps to ensure that they play fair by you. And yet, because it was sold so aggressively across apps, many unsuspecting customers jumped in without questioning the offer. That's why SEBI recently put out a caution note regarding digital gold. The note was a reminder to everyone. India already has regulated ways to invest in gold. From gold ETFs by mutual funds to electronic gold receipts you can trade on exchanges to even gold derivatives on commodity exchanges. The digital gold you see on many apps, however, is not one of them. It sits outside SEBI's rulebook. In fact, back in the Union Budget for FY 21-22, Finance Minister Nirmala Sitharaman had announced that SEBI would be made the regulator for a dedicated gold exchange. That announcement signaled that the government was thinking very seriously about bringing order and transparency to gold trading. So far, the project hasn't gone anywhere, but the need for one very much remains. So what exactly is the problem with digital gold? Let's dive in. When you buy a stock through a broker like us, your shares don't actually sit with us. They're in the demat account that's maintained with government-backed depositories, that is CDSL or NSDL. If we were to go down someday by some misfortune, your shares would be safe. They would remain in a completely separate system with legal protections and audits. Your assets aren't mixed with our balance sheet. Gold ETFs work in the same way. While you see your units of such ETF on your broking app, there's a whole regulatory backend underneath. Trustees, custodians, auditors, daily NAV calculations, expense ratios, all of which have to be disclosed. This is all governed by SEBI. You aren't just trusting one company's word. You're buying into the system bound by clear regulations. On the surface, digital gold looks and feels the same. A digital gold app might tell you that they're buying physical gold against every rupee you give them and are storing it in a vault somewhere with a private contract marking the transaction. Maybe there's even a trustee involved. Your account will tell you exactly how much gold you own. Sounds legitimate, right? Well, it might look that way, but you own that gold under the terms and condition that the company sets. Anyone can start an app and sell digital gold to you. There's nobody checking after them. They don't come under any SEBI framework, nor are they vetted by any other verified legal institutions. If that company is running well, it might not make a difference. But if it fails, you are unprotected. You can't recover your gold. All you have is a private contract and the very specific terms it contains. There's no wider framework to fall back on. In other words, you're taking on a counterparty risk. You're betting all that money purely on the trust that you have in that app. Even if you trust a digital gold seller, there are major questions that you might not know the answer to. For instance, is your gold actually segregated, or is it pooled with everyone else? Are you a beneficial owner of specific bars with serial numbers, or just a general claimant on a very big pile? Without a legal backstop, there are no standards to any of this. See, regulated markets force transparency. An ETF must publish a daily NAV. You see buy and sell prices on the exchange. The expense ratio is very well documented. Dig around and you'll know exactly what you're buying. But without regulation, this outside push for transparency doesn't exist with digital gold. Consider this. The moment you tap buy on an app, you're treated as if you're purchasing physical gold. Just that you've deputed someone else to do so and keep it on your behalf. Physical gold under Indian tax law attracts 3% GST at the point of purchase. There's no way around that. Whether you ever see a bar or coin or not, you have to pay that tax because legally it's a sale of goods, not an investment transaction. And so, if you put 10,000 rupee into digital gold, 300 of that immediately goes into GST. In a sense, you start your investment with your portfolio 3% down. On top of that, add the spread. Since there's no exchange or common price feed, each platform sets its own buy and sell quotes. They might say that they're taking this to cover hedging, vaulting, insurance, and logistics. But in practice, if you buy gold and then sell it back immediately, you'll still get about 2 to 3% less than what you paid. That spread is how the platform earns. Put that together, if you put in 10,000 rupees, 300 rupees is gone in tax. Another 200 to 300 goes to the platform. You are instantly looking at a 500 to 600 rupee loss as soon as you invest. In other words, your 10,000 investment only buys you 9,400 or 9,500 worth of gold. SEBI's note is a reminder that while digital gold might sound sleek and modern, underneath it's still an unregulated product. You might choose to trust it anyway, but at the very least, you should understand the risks you're taking on. If something were to happen to the platform selling that gold, there's no safety net. There's no SEBI or stock exchange to bail you out. Your only real recourse is to go through the normal court system, seeking the very same assets that all of the company's creditors will be after. If you're looking for an exposure to gold, a ready alternative might be a gold ETF. Just like digital gold, they give you a claim on certain amounts worth of gold. Unlike digital gold, however, they are regulated, transparent, and even liquid. You can buy them through any broker at a public price, and your holdings sit safely with the depository, far from the controls of the broker that you bought them from. And now on to the second story for the day. Throughout October, we had seen a series of headlines that, at first glance, barely made any sense to us. The government was making a strong push for gasification of coal. To this end, it recently opened auctions for sites where this could happen underground. This made very little sense to us. Coal was, as far as we knew, clearly solid. How would it become gas? Why would you even try? Those questions launched us into a deep and fascinating rabbit hole. Some of this, we realized, was intuitive. If you've ever tried to light a bonfire or start a barbecue, you've probably realized how unpredictable and messy burning something solid can be. Gases, in comparison, are relatively simple. They create an even flame that you can literally control with a knob, just like your kitchen stove. This is what India is leaning into. We're trying to convert solid coal into a gas called synthesis gas or syngas, a mix of carbon monoxide and hydrogen. Not only is this potentially a better fuel source, it can also lend itself to a range of other industrial applications. This is, however, a challenging and controversial project, and success is not guaranteed. Turning coal into a gas isn't a new idea. We've been doing so since the 19th century. Ever notice those old-timey gas-powered street lamps? They were all running on coal gas, or what was called town gas. In fact, in large parts of the developed world, right until the 1970s, most homes and businesses would be connected to town gas pipelines, using it for lighting, heating, and cooking. In fact, it was only when we discovered large reserves of cheap natural gas that entire countries chose to switch over. When something burns at a molecular level, the heat is pushing it to react with any oxygen it can find nearby. To make coal gas, we take it a halfway there. In a process called partial oxidation, we heat coal to very high temperatures at 700 to 1600 degrees Celsius, but starve it of oxygen so that it can't burn well. The unburnt gases this creates once processed are the syngas that we want. Here's how it works. Coal isn't just carbon. It naturally contains a lot of water and several volatile compounds like tar, methane, and much more. So to begin with, we devolatilize coal. We heat coal up to 350 to 700 degrees Celsius, letting all of this escape. This leaves us with carbon-rich char. From there, to get to syngas, we need a lot of heat. And so we start burning some of this other char under limited oxygen, between 1/5 to 1/3 the oxygen you would need to burn it completely. In this suffocated state, the coal only burns partly, creating a lot of carbon monoxide. But that's enough to heat the mix up to extremely high temperatures. Now, throughout this hot, oxygen-starved environment, you finally run a gasifying agent, a carefully controlled stream with small amount of oxygen or air and steam. In a series of chemical reactions, the carbon in that char practically snatches away the little oxygen available, leaving behind a mix of hydrogen gas and carbon monoxide, both of which burn easily when exposed to more oxygen. Once cleaned, you get a gas that can burn very cleanly. Now, we understand this was very technical, but was very important to explain. Traditionally, most coal gasification happened in large industrial facilities once it had already been dug out of the ground. This required large setups built around high temperature, high pressure steel gasifiers. Establishing such a setup could cost as much as $300 to $500 million. But we've also been experimenting with another possibility, one that eliminates the need to mine coal altogether. Instead of digging coal, bringing it to the surface, running it through this sophisticated industrial machinery, one can gasify it inside the coal mine itself. You bore wells right into the coal seam deep underground, inject your gasifying agent straight in, and pump out syngas to the surface. To be clear, this is far from easy. You're basically lighting a large fire deep underground where nobody can observe it directly and trying to control how it spreads. This is exactly as hard as it sounds. But it has a big advantage, which makes the method transformative. It unlocks unminable coal blocks. Something between 1/6 and 1/8 of the world's coal reserves can be mined economically using conventional methods. The rest, for all intents and purposes, just geographical curiosities. They are too deep or too hard to access by a mining crew, or are in geologically sensitive zones that could easily cave in. Government estimates that the large part of India's coal, at least 40%, is currently unminable. Gasification allows us to make those reserves useful. Now, why should one gasify coal? Coal is a dirty, bulky solid. Gasification turns it into clean, versatile gas. It takes the same finite carbon resource and allows you to use it much more intelligently, extracting energy and value, controlling pollutants, and much more. Here is the promise in this: environmental friendliness. We're in an era where climate change and escalating pollution levels are forcing us to rethink our use of coal-based power plants. And yet, coal is India's only abundant energy reserve. We have 378 billion tons of coal, enough to last us 147 years at current rate. Gasification gives us an alternative. Syngas isn't a clean fuel. It is made from coal and contains all the pollutants that coal does, compounds of sulfur, nitrogen, mercury, and the like. But crucially, those pollutants are easier to deal with. Coal releases those pollutants upon burning as a heavily diluted exhaust gas. At these low levels of concentration, it's all but impossible to scrub out those pollutants. In contrast, in syngas, you can remove the same pollutants before it is burned. They're still highly concentrated at this point and are easier to separate out. Some, like sulfur, can actually be sold as a byproduct. There's a caveat here, however. Burning syngas creates 2.5 times as much carbon dioxide as you would have by simply burning coal. Those environmental benefits only show up when you combine it with carbon capture and storage program, which has never been deployed at any scale in India. Syngas can be burnt, but it's more than a fuel. It's a concentrated stream of carbon monoxide and hydrogen, the composition of which can be controlled, which makes it tremendously useful in industrial applications. In fact, the name synthesis gas comes from its ability to synthesize things. For one, syngas can be an intermediate towards cleaner fuels, from simple gases like methane or hydrogen to complex liquid fuels like jet fuel or synthetic diesel. It can also be used as a precursor for various chemicals. For instance, its hydrogen can be separated out and used to make ammonia for fertilizers. Consider this: 40% of world's urea is made in China through coal gasification. India, meanwhile, imports 7 to 8 tons of that fertilizer every year. Similarly, syngas can also be used to make methanol, which goes into plastics, resins, and other products. Since syngas is oxygen-starved, it's also a great reducing agent, which sucks oxygen out of a product. This has major uses, for instance, in the steel industry. The short point is this: right now, our coal is at best used to create electricity, and that too at low levels of efficiency. Those same reserves, however, can be made more flexible and then used in creating a range of high-value industrial products. In 2021, India came up with an ambitious plan. We would invest a total of 4 lakh crore by 2030 to set up enough capacity to gasify 100 metric ton of coal a year. This promised to solve serious problems for us. We are deeply energy starved and rely on imports for most of our energy needs. We also spend heavily on importing urea, methanol, and other industrial products. Collectively, this amounts to billions in annual import exposure, as well as deep strategic vulnerability. Gasification would solve all those problems in one go. Now, to a private investor though, making investment in gasification would be a daunting affair. Gasification plants require tremendous amount of upfront capital expenditure with no expectation of return. Most modern gasification technologies are designed to work with much higher grades of coal than that are available in India, leaving no easy plug-and-play solution that you could purchase. And any cheap source of natural gas can quickly run you out of business, as had happened in the United States once it discovered shale gas. This is why the government is offering major SOPs to anyone willing to enter this space. The National Coal Gasification Mission tried to solve the many uncertainties of gasification business comprehensively. To make the upfront capex less daunting, it announced financial incentives of more than 8,500 crore. Half of that would go to PSUs, but the other half was earmarked for private players. The government is also offering 50% rebate in the revenue it would otherwise take for those coal blocks. That makes up for the costs. But there was also a technological challenge. The quality of Indian coal is poor, with 30 to 45% ash content. This makes gasification dramatically harder. You have to spend much more per unit of syngas, and once you're done with, you're left with large amounts of slag that you have to dispose of. Some countries like South Africa have been successful in working with poorer coal qualities, but ultimately, India probably required specialized technologies for our own grades of coal. We haven't quite cracked the problem yet, but the government is sponsoring major projects to develop indigenous gasifiers. Finally, it's trying to remove the uncertainty around finding a buyer by creating guaranteed demand. To this end, it has set up joint venture between Coal India Limited and a series of PSUs, which is GAIL, SAIL, BHAIL, and much more, all of which will use coal gas in industrial applications. These could become guaranteed marketers of any syngas you could sell them. That brings us to the headlines we started with, which mark a major step ahead. At the 14th round of India's commercial coal mine auctions, which started late this October, the government auctioned 21 blocks that, for the very first time, were identified as having potential for underground coal gasification. Before this, our gasification mission focused on surface gasification projects. The newest round, however, opens the door to underground gasification. In a sense, this marks a new frontier on what mining even means. For anyone willing to try this new approach, the government is offering massive SOPs. Any bidder would get a discount on upfront payments to be adjustable against future royalties. Efficiency parameters would be liberalized and regulatory approvals would be fast-tracked. The most critical and controversial component of this new policy, however, was that pilot underground gasification projects were exempted from environmental clearances. Normally, all coal mining projects in India must go through an environmental impact assessment, after which they must seek government clearance. This is a lengthy process, but for the first stage of new underground gasification projects, the government did away with this completely. This would strip away the biggest source of red tape and bureaucratic delays from the process. To the government, this was essential to simply get the experiment off the ground. At the same time, however, this made many environmental experts very uneasy. This is an unproven technology and could create major issues. The biggest problem, perhaps, is the possibility of groundwater contamination. This has happened before as well. Underground gasification tests in the United States, for instance, started contaminating the surrounding groundwater from the pilot stage itself, as carcinogens like benzene, phenol, heavy metal, and other tars started entering surrounding aquifers. Similarly, in Queensland, Australia, such efforts were banned entirely in April 2016 after a pilot project caused serious environmental damage. There are also other problems, from the possibility of land collapsing to a high chance that one can lose control of the reaction process. With such risks, some consider it deeply dangerous to do away with environmental checks. Now, to be fair, however, the government isn't creating a free-for-all. In its draft guidelines on the underground gasification, it tried to ring fence against those dangers, requiring a pilot feasibility study, comprehensive monitoring of groundwater, and setting up online sensors to track any contamination in real time. This hopefully could limit some of the danger. Now, will these auctions be successful? Will we actually gasify our coal? On paper, coal gasification promises to make India's dirtiest fuel more versatile and to unlock reserves that would otherwise stay buried. If this experiment succeeds, we could create serious value out of our coal endowments, fueling everything from power plants to chemical refineries. But that promise isn't a guarantee at all. There are serious challenges still: environmental challenges, engineering challenges, economic challenges, and much more. Either way, this moment marks a turning point, a complete reinvention of how the dirty, bulky energy source works. And finally, on to the tidbits for the day. First up, unemployment fell to 5.2% in July-September quarter, from 5.4% in the previous quarter, with rural joblessness at 4.4%. Self-employment rose to 55.8% of total workers, but youth unemployment climbed to 14.8%. The share of salaried jobs dipped slightly, showing continued stress in formal hiring. Next up, the government has proposed new rules requiring online platforms to add a country of origin filter, allowing buyers to identify Indian-made goods easily. The move aims to give local manufacturers more visibility and boost the Make in India initiative amid rising global tariff tensions. Finally, SEBI has found evidence of up to 100 crores siphoned off from around 20 SME IPOs managed by First Overseas Capital Limited. Funds meant for business expansion were allegedly routed to promoter-linked entities. More enforcement orders are expected in the coming months. And that's it for today. We'll see you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.